Hi, good afternoon. As promised, I'm following up on our earlier discussion of cash flow analysis. And so we were working on problem 4-9 out of our textbook. And in that problem, they provided you with an income statement and two balance sheets over a 2-year period. And if you recall, you should open up your book and go to that particular problem, 4-9, so you can see it in front of you. But if you recall, what the income statement showed was $900,000 in sales revenue. Now, if you recall from earlier discussions, sales revenue is a temporary account, which means it starts out at the beginning of the year with a zero balance. It ended with a balance of $900,000 during the year. So what's happened here is we have booked $900,000 worth of sales. So where's the other side of this? Because this is a credit balance account. Well, the rest of it went into accounts receivable. Accounts receivable started off the year with a $100,000 balance carrying over from the previous year. It ended with a balance of $120,000 in it. Okay? It was increased $900,000 via the sales revenue for the period. So your accounts receivable is currently out of balance. It doesn't add up. You have $1 million in accounts receivable when you have an ending balance of $120,000. So the difference is $880,000. What do you do with that? Well, you credit accounts receivable for the $880,000. What does that $880,000 represent? It represents the cash that customers paid. So they're paying off their bills. They owe you money, they're paying it to you. So that becomes cash received from customers. So if you look at the cash account here, that $880,000 is the cash received from customers. Okay? It's the debit entry that matches up with the credit entry on accounts receivable. So the flow of this is when we make the sale, we debit accounts receivable and we credit sales revenue. When the customer pays us, we credit accounts receivable and we debit cash. We scroll down. This is the top part of our statement of cash flows. It's cash flows from operating activities. The first line is cash received from customers, $880,000. And that matches our analysis here. All right, now the second problem we want to tackle is how much did we pay our vendors and suppliers? And to answer that question, we're going to take a look at the expenses and the accrued liabilities. And so we know for expenses, we ended the year with $700,000 in operating expenses. We started the year with zero. It's another temporary account. Accrued liabilities started off with a balance of $60,000 and ended with a balance of $70,000. So how did we get there? Well, first off, they gave us a piece of information and said there was $30,000 of depreciation expense included in operating expenses. And so we're going ahead and record that. So we debit operating expenses $30,000, and then we credit accumulated depreciation $30,000. Now that means we're still short in the expense count here, $670,000. So where did the rest of that come from? Well, that would have been all of the other stuff that we did during the course of the year to make money. And so we go over to accrued liabilities, and what we're going to do here is we're going to debit the expenses, $670,000, and we're going to credit the accrued liabilities for $670,000. That gives us a grand total of $730,000 in accrued liabilities. We already know the balance at the end has to be $70,000. So how do we get from $730,000 to $70,000? Well, that's the cash we actually paid out. And so that would show up as a debit to accrued liabilities for $660,000. That represents the difference between the $730,000 and the $70,000 ending balance. And then, of course, the credit will go to cash, $660,000. And so that $660,000 represents cash paid for operating expenses. And so if you come back here to the start of our statement of cash flows, we have cash paid for operating expenses, $660,000. So that's the way you kind of work through the statement of cash flows problem when you're looking at the direct method. Direct method, again, only refers to the top portion, the operating section. The investing and financing sections do not change regardless of which method you use, direct or indirect. Those two sections are the same. The only section that's different is the operating section. Indirect method, we start with net income and we adjust it. Here, we're going to look at things like cash received from customers, cash paid to suppliers and vendors, and we'll work through a number of others that we'll talk about in class next week. So thanks very much. I hope this helps you out in some small way. And go forth, do good, and tackle the rest of this problem.